Whenever a strategist uses the word terrifying.
Did I say that?
Yes, you said that to our segment producer. It really catches our attention. So what should we be concerned about?
But I'm concerned. So what I'm concerned about is we are 7 years into a full-fledged, all-out central bankers doing everything they can to stimulate demand. And yet, sales growth is actually decelerating. We haven't really seen this demand recovery. And then the other day, we looked at all of these indicators that have been pretty good at forecasting recessions, and we extrapolated that if they follow the current trends they're on, we're going to hit a recession sometime in the second half of next year. So a recession in the next 12 months, which I don't think is discounted into the market at these levels. So, it's like you look at the data. I'm a data-driven gal, and I just don't see the underpinnings of support that I'd like to see in order to get bullish from here. I agree with you. I think that it's more risk than reward at this point. How big that drop is, our year-end target is 2,000, which is like 7 percentage points lower than where we are today. But what scares me is the market has been so fragile. So remember what happened in January? We got a whiff of bad news, and all of a sudden the market's at 1,800. And I think that speaks to the reaction function of the market. It's very, there are a lot of itchy trigger fingers. There's a lot of violent trades that can really roil a fairly complacent
So when you tell
environment.
clients, because I listen to all of that and I think, I want to be in cash. But obviously, as an equity strategist, you're probably not saying clients be in cash.
Yeah, you got to be. If you got to be invested, I think the two sectors that look the best to me right now are healthcare and tech. And the reason is they're both pretty cheap on a relative basis. They're like healthcare has taken it on the chin because of Hillary risk and fears that the M&A cycle is over. It's now trading at almost the lowest multiples we've ever seen. But meanwhile, it actually has good growth. It's one of the few sectors that's been posting good growth. It's had great earnings surprises and sales surprises over the last couple of years. And it is hated at this point. And that I think is critical because positioning has driven a lot more than fundamentals over the last several years. The fact that nobody wants to touch healthcare until after the election means to me that it might be a good buying opportunity.
So I'm curious, you said 2017 we could be looking at a recession. If the folks at home, is there one indicator that they should look at that if it turns this particular way that, hey, you know what, it is time to take some profits?
The holy grail. Yeah, unfortunately, there is no single indicator that has accurately predicted every recession. I mean, obviously, if there were, none of us would be here. But I think, the ones that we looked at were ISM, which has had a pretty good lead on recession. The slope of the yield curve, new building permits, temporary employment trends, and then, of course, I'm blanking on the last one.
So it's okay.
But yeah, read our report, and you'll find out what the last one is.
I mean, because that's something that I find. ISM has a fairly good record and a long history of looking at. So folks at home see an ISM below 50, then they should get concerned.
And the yield curve's been steepening.
And the yield curve's been steepening a little bit. But in general, if you take a longer-term trend, and I agree, I think the devil is in the details here. If we do see a reversal in any of these indicators, then I would change my tune. But if you extrapolate from the general trend, and the yield curve steepened, but like you said, rates are still, what are they, 175? I mean, is that really
it's not enough to push.
Last question, what's the sector you should just stay away from? Screaming sell at this point in terms of valuation.
Yeah, so when I look at all 10 sectors, I think consumer discretionary still to me looks like a little bit of a trap. So first of all, it is the most labor-intensive sector in the S&P. Right. This is where you're seeing wage pressure starting to crimp margins. You've got tremendous deflationary pressure from new entrants like, fast fashion, Airbnb putting pressure on hotel prices. This is basically a sector that's being disrupted, and deflation is what we're seeing. So margin pressure plus deflation, not a great story.